Today we show you 3 MACD trading strategies complete with trading rules and backtests. All backtests are based on S&P 500 and the ETF with the ticker code SBUY, and the best strategy comes last, so make sure you stick around until the end. By the way, we appreciate your support. If you want to help our channel to grow, please give this video a like and consider subscribing to our channel. Let's get straight to it and present the first strategy. The first trading strategy is based on the MACD histogram. The MACD histogram is the fast line subtracted from the slower signal line. This is a mean reversion strategy and the trading rules are on the screen. We do this by buying when the MACD histogram drops 4 days in a row from a level that was below 0 4 days ago. The equity is growing nicely upward, but the annual returns of 5% fail to beat the buy and hold of the S&P 500, but that is explained by the low time spent in the market, only 5%. Considering this, we believe the strategy is decent because the low investment time frees up time to trade other complementary strategies. The positive is that the strategy has a very high win rate of 89% and a low drawdown of 16%. Let's go to the second backtested MACD strategy, which uses a Bollinger Band of the MACD histogram. We enter a long position when the histogram crosses below the lower Bollinger Band, and we sell when the histogram crosses above the upper band. The 100,000 invested grows to 1.15 million today, which equals an annual return of 8.4%. The strategy's performance is mixed. The positive takeaway is a solid win rate because we believe the win rate is crucial for most traders to stick to a strategy. However, the negative is the huge drawdown of 44%. With such a drawdown, we believe most traders would abandon the strategy, even though the strategy performs almost as well as buy and hold, despite being invested just 64% of the time. Now, the third strategy is the best one. Unfortunately, we only reveal its trading rules for our members, but we can indicate that the RSI indicator is involved. The strategy has only one trading rule to buy and one to sell. The 100,000 invested compounds gradually without major hiccups along the way, and we end up with 1.5 million today. This strategy has 3 positives. It spends only 21% invested, has a max drawdown of only 15%, and the annual return is almost as good as buy and hold. It has many trades, and the average is 0.56% per trade, but it should be plenty of margin to pay for slippage and commissions. The risk-adjusted return is 43%. This number is the annual return divided by the time spent invested, which is 0.21. We have now shown you 3 MACD strategies. Let's discuss why we use the trading rules and settings we did. We have been trading full-time for 20 years, and we have learned a lot by using the MACD indicator for some of our strategies. First, what is the best MACD strategy for trading, and is MACD good for trading? The MACD indicator is not the best indicator for trading. We believe that is the RSI indicator, but the strategies in this video show that MACD can be very useful. Please also see the next video coming up about 3 RSI trading strategies. The optimal approach to utilizing MACD is by employing it as a mean reversion strategy, similar to the 3 strategies outlined in this video. The objective is to purchase assets when the market is oversold and the price has fallen, and to sell them when the MACD readings are high. This approach follows the conventional notion of identifying oversold and overbought conditions. Although the MACD indicator cannot predict the future, it provides a probability assessment. Historically, the MACD indicator has demonstrated effectiveness in certain asset classes, especially stocks, making it suitable for short-term trading. Now let's address the question of which markets MACD performs best in. The answer is quite straightforward. MACD tends to work well in stocks, particularly stock ETFs. However, its efficiency diminishes when applied to other types of assets. The explanation is straightforward. The stock market has a tendency to exhibit mean reversion. This implies that oversold MACD readings indicate the likelihood of better returns in the upcoming days, whereas high readings suggest lower returns compared to the average. During the past 35 years, most Western stock markets have exhibited characteristics of mean reversion. Nevertheless, it is important to note that there is no guarantee that this pattern will persist in the future. Determining the most effective MACD settings is relatively straightforward. Optimal results are achieved with a look-back period of just a few days. Daily bars serve as the best time frame for analysis, although weekly bars can also yield satisfactory outcomes. When it comes to day trading, MACD is not particularly suitable. It performs best in swing trading scenarios using daily or weekly bars. As for the best combination with MACD, incorporating one additional variable might improve the results, but please make sure you are not curve-fitting your strategies. On our website, we provide a couple of strategies that incorporate another indicator, resulting in improved performance. That's all for today. We hope you got some value out of it. Please help us grow on YouTube by giving the video a like, comment, or subscribing. It helps us a lot with the YouTube algorithm. Please keep in mind that nothing in this video is investment advice.